You didn't buy ABTC for a lecture on how little your thesis matters when liquidity disappears. You bought it because the pitch sounded unusually concrete for a crypto-linked stock, a NASDAQ company that both produces Bitcoin through mining and accumulates Bitcoin in a strategic reserve. Then, into the close, ABTC traded like the market had decided the story was irrelevant. American Bitcoin Corp trades on NASDAQ as ABTC. On the session that turned this ticker into a warning label, ABTC finished regular trading around $2, down roughly $1 and change, about a 40% drop. The tape printed an intraday low around $1.7 and an intraday high around $2.7. That is not typical volatility. It is stress volatility, urgent selling colliding with a thin bid. The most psychologically damaging detail is the low, about $1.7 aligned with the 52-week low, dragging the stock to the edge of its entire year in one session. After hours, then showed a small rebound around $2.3, enough to create a question that keeps investors awake. Was that the end of forced selling, or only the first break in a longer unwind? The mystery isn't that ABTC fell. Crypto-linked equities fall. The mystery is that it fell while ABTC's fundamentals narrative, backed by specific disclosures, looked like it was strengthening. ABTC describes itself as a Bitcoin accumulation platform with two engines. Engine 1 is self-mining, operating industrial-scale Bitcoin mining infrastructure to produce Bitcoin. Engine 2 is a strategic Bitcoin reserve, accumulating and holding Bitcoin on the balance sheet so shareholders get treasury-like Bitcoin exposure through the public equity. Investors hear two engines and imagine two paths to upside. In practice, it often means two paths to volatility, sensitivity to Bitcoin price and sensitivity to mining economics. That vocabulary matters, so define it precisely. Bitcoin mining is a computational competition that secures the network. Specialized machines called ASICs, application-specific integrated circuits, perform hashing operations at massive scale to compete for block rewards paid in Bitcoin. Hashrate measures how fast that hashing work is performed. Exahash per second is an industrial unit that reflects scale. Efficiency is often expressed in joules per terahash, measuring energy consumed per unit of hashing. Lower joules per terahash is better because electricity is a dominant variable cost. Efficient fleets can stay viable through downturns. Inefficient fleets can be forced offline when Bitcoin price drops or network difficulty rises. ABTC emphasized those operating levers. In September 2025, it reported roughly 24 exahash per second of hash rate, supported by about 16,000 active miners, with average fleet efficiency around 16 joules per terahash. Those numbers anchor the miner half of the thesis, an attempt to convince the market this is industrial capacity, not a narrative wrapper. Then ABTC reinforced the reserve half. Around October 24, 2025, it disclosed securing about 1,400 additional Bitcoin, bringing its strategic Bitcoin reserve to about 3,900 Bitcoin. Later reporting referenced about 4,000 Bitcoin held as of November 5, 2025, valued around $400 million at the time. ABTC also noted that some Bitcoin could be held in escrow tied to ASIC purchase agreements. That escrow detail matters because in a normal treasury story, investors assume the asset is liquid and unencumbered. Escrow implies commitments and constraints. It can signal expansion plans, but it also changes what Bitcoin held means for immediate flexibility. Third quarter coverage added what should have been stabilizing data. Reuters described results for the quarter ended September 30th, 2025. Revenue around $64 million versus about $12 million a year earlier, net income around $4 million versus a small prior loss, and gross margin in the mid-50% range. In many growth equities, that kind of trajectory supports a higher multiple. ABTC instead plunged into its year's floor. That's where you have to stop asking only what happened to the business and start asking what happened to the stock, because ABTC's public market path makes structure unusually important. Reuters reported that American Bitcoin was launched with involvement from Eric Trump and Donald Trump Jr. in March 2025, and that the company would go public via a stock-for-stock merger with Griffon Digital Mining, with trading beginning on September 3rd, 2025. This transaction-driven listing matters because it often produces complicated cap tables and float dynamics, multiple holder groups, different restriction schedules, different resale registration statuses, and different incentives. The ticker may look like a normal public stock, while the underlying ownership still behaves like a deal. To understand why that can explode, compare it to what is normal. In a conventional IPO, insiders and early investors are usually subject to a lockup, often around 180 days, during which they cannot sell. The lockup calendar tends to be widely known, analysts discuss it ahead of time, and liquidity usually deepens over time as the shareholder base broadens and market making stabilizes. When lockups expire in mature IPOs, selling can occur, but it is often partly anticipated and partially absorbed. Media accounts linked ABTC's collapse to lockup expirations or restricted share releases, meaning more shares became sellable. That is not procedurally mysterious. What is mysterious is the magnitude and speed. About 40% down into a 52-week low suggests urgent, concentrated supply meeting insufficient demand. Market microstructure explains how that happens. If concentrated selling hits a thin bid, the order book becomes shallow. As price drops fast, liquidity providers widen spreads or step back. Stop-loss orders and margin calls can trigger more selling. The decline generates more decline, a cascade. The market can appear to be reacting to information even if the move is mostly mechanical. This is why long investors feel trapped, because the chart manufactures suspicion, and suspicion invites more selling. Several plausible hypotheses fit the facts and matter to investors. One hypothesis is concentrated selling by newly sellable holders who preferred certainty to price, de-risking, diversifying, or meeting mandates. In a highly liquid large cap, blocks can be absorbed. In a newer narrative-driven equity, they can dominate. If this was the driver, it implies ABTC's liquidity remains fragile relative to potential supply events. A two hypothesis is float mispricing. The market may have underestimated how many shares would effectively become sellable or how quickly holders would sell. In normal cases, float expansions digest across days or weeks. A one-session repricing implies expectations and reality were far apart, a gap that can recur if there are additional supply milestones. A three hypothesis is a sector amplifier. ABTC is high beta to Bitcoin plus mining execution. High beta instruments tend to outperform in risk on phases and underperform sharply in risk-off phases as correlations spike and investors delever. If the broader crypto equity complex was being repriced, ABTC's structural shock would hit harder. A four hypothesis is valuation instability. ABTC is a hybrid. Miners are often valued on operating economics. Bitcoin treasury vehicles are often valued with reference to Bitcoin held and the premium or discount investors assign for execution and dilution risk. When the market lacks a stable valuation anchor, it anchors to risk. A supply shock increases uncertainty abruptly and widens the discount demanded, forcing price down. This episode matters because it resets the narrative regime. Before the collapse, ABTC could lead with mining scale and efficiency, reserve growth, and improving quarterly metrics. After the collapse, the dominant question becomes whether the supply overhang is finished. Until the market believes forced selling has ended, rebounds can be sold into, not because the business is broken, but because investors fear the next wave. And this becomes fundamental adjacent because equity price affects cost of capital. Mining is capital intensive, machines, facilities, power. Reserve strategies rely on capital allocation trust. If the stock trades like it can be crushed by supply shocks, future fundraising can become more expensive or more dilutive, which can affect execution over time. Structure can become fundamentals. So what can investors do without pretending certainty? Start with the levels the tape already gave you. About $1.7 is the structural floor. It was the intraday low and the 52-week low. In a typical stabilization, you want repeated tests with shrinking volatility and fading volume, signals that forced selling is transitioning to voluntary trading. The speed of ABTC's tag suggests liquidity stress, meaning retests can come quickly. The close around $2 is a pivot, but not confirmation. The after hours around $2.3 is a checkpoint, but after hours is thinner and can be noisy. Normal reversals need confirmation during regular hours with narrower ranges and lower volume. The $2.7 intraday high is the first meaningful upside checkpoint. Revisiting it would suggest a real retracement rather than a cosmetic bounce. Three strategies follow. Short term, treat ABTC as a volatility instrument. Use roughly $1.7 as the invalidation line. A decisive break implies fresh low discovery with unknown support. If ABTC holds above $1.7 and reclaims the 2.0 to 2.3 zone in regular hours, a tactical retracement toward 2.7 becomes plausible, but sizing and stops should reflect that structure is the driver. Medium term, require digestion evidence. Healthy post-shock behavior is compression, volume fades, ranges narrow, and violent drops become less frequent. Sustained trade above roughly $2.3 with volatility compression can reopen the path for the market to price fundamentals again. Scale, efficiency, reserves, and the Reuters described quarter ended September 30th, 2025. Repeated failures to hold argue for patience. Long term, accept the dual bet and demand transparency. Long holders are underwriting Bitcoin's cycle and ABTC's operational execution while acknowledging float and dilution risks can dominate short-term price. Long-term success requires sustaining industrial performance, roughly 24 EHS and mid-teens JTH, and maintaining reserve clarity about 3,900 Bitcoin as of October 24th, 2025, and about 4,000 Bitcoin as of November 5th, 2025, while developing a more stable equity profile the market can finance. If you want this channel to cover more tickers like this, help me build the radar. ValueStir is actively taking tips from listeners on stocks and coins, public, private, or even names that are expected to list soon. If there's a name you want investigated, drop it in the comments with the ticker if it has one, and a short note on what feels off or what feels misunderstood. The best leads come from people who are living inside the tape every day. And to everyone who stays to the end, who subscribes, who hits like, who leaves thoughtful comments, and who shares these episodes outside this platform, thank you. I see the effort, and I will repay it with sharper research, clearer explanations, and better storytelling. That is the resolution of the mystery. ABTC didn't need a hidden business failure to deliver a collapse. It needed a moment when share supply, liquidity, and investor psychology overwhelmed the story. If you felt blindsided, it's because you were analyzing a company while the market was trading a structure event. For now, structure is the narrative. This was ValueStir.